Clyde, folks, we're really going to begin, so I need folks to move. Robert, Clyde, out. Quiet. Give yourself all a round of applause for making it so far today. This has been great. I also want to thank all of those people who are watching online. For those who've come on, I'm Steve Clemens. I direct the American Strategy Program here at the New American Foundation. It's great to see Martin Bailey up here, a good friend. We've had a very robust day. Our task has been to focus on this question of what the benchmarks of performance for the London G20 Economic Summit should be. How should we think about the global crisis? What are the levers we should be thinking about? Thinking about domestic drivers of demand, the jobs issues in America, the social contract in this country, but also thinking through the international implications. And I've asked George Soros, a good friend who's a well-known philanthropist, of course, the head of Soros Fund Management. The interesting thing about George Soros is he sort of writes about his decisions very transparently. And there was a piece, I guess it was the New York Times, looking at how various financiers did and whether they put their money behind what they were saying. And George did rather well last year, I should say. Others have done well. Many who've been listening to George at the New America Foundation events in the past, so we're doing fine. But on the process, what I find interesting about George Soros, who gave a talk at the Council on Foreign Relations not too long ago on an earlier version of this book, which is not officially out. It comes out March 30th. It's called The Crash of 2008 and What It Means, The New Paradigm for Financial Markets, which includes 4 new chapters on this. When he originally wrote this book, he kind of left us hanging about how his accounts had done, sort of largely floundered along, and I think now we've seen how they've done better. But what he's basically said is that it's also, as you looked at credit default swaps, as you looked at the role of central bankers, whom he made the comment at the Council on Foreign Relations, all central bankers are doomed to fail, which was an interesting comment, but also looking at the fact that his kind of investment needs a response. As you begin looking around the world, you look at regulation, you look at what a healthy global financial market is. Soros has been writing about this for some time. And as I mentioned at a dinner we had last night, I found my notes from a senior economic summit in Hakone, Japan in 1999, right in the wake of the 1997-98 East Asian economic shocks. And many of George Soros's comments, which were widely discussed at that forum 10 years ago, are not dissimilar from the kind of comments that he's been making today. And I think it's important for us not to look at this as something, as Vice President Cheney said not too long ago, where people didn't see this coming. In fact, many people in this room did see this coming. So I do want to recommend George's book. I'm grateful to him for sharing his thoughts today. We'll have a discussion with all of you, and then we'll proceed with closing thoughts or the comments. But thank you, George.
Very good. Well, you have been exposed for 4 hours to various aspects of the financial crisis, so I think you've been softened up sufficiently. I will now attempt the impossible, which is to try to bring the whole situation into a conceptual framework in which it can be understood. What we have is a pretty complete breakdown. The financial system has broken down. This crisis is different from any crisis we have experienced in our lifetime because in the past, whenever we came close to a breakdown, the authorities got their act together and did something to prevent it from really going over the brink. This time, it did go over the brink, and actually it was really the failure of Lehman Brothers that changed the game, and what had been purely financial crisis really then affected the real economy in a very large way, and we've been in a free fall since then. So with this pretty complete collapse, I think you need to do some pretty profound rethinking of the framework in which we look at the world. And that's what I'd like to put before you. And I will start with, of course, with the financial markets, the economic theory. One of the salient features of this crisis was that it really originated in the financial system itself. And that contradicts the prevailing view of financial markets, the paradigm that has been guiding us, namely that financial markets basically tend towards equilibrium, and they are self-correcting, and deviations occur in a random fashion. And they are usually, or they're always, caused by some exogenous factor that affects the markets, and the markets have difficulty in adjusting to it. And so you have these dislocations, these deviations. But here, this is contradicted by the fact that here the crisis was generated. It started with the subprime market that collapsed, and then it spread with remarkable speed to all kinds of other markets, seemingly unrelated and until the entire market collapsed. And in this case, the authorities failed to prevent it. So the prevailing paradigm has failed, and we need a new paradigm. And I would like to propose one. The prevailing paradigm says that financial markets basically reflect accurately all the available knowledge and give us accurate reflection of the underlying reality as you can have. I suggest that that is not the case. That in fact, financial markets always distort reality. The degree to which they distort it varies. Sometimes distortion is very big, sometimes it's small, but there's always a distortion, there's always a bias. Partly because financial markets deal with the future, and the future is not a matter of knowledge. It's a contingency that you have to guess at. So you have to have some bias, you have to introduce some judgment. So the whole discussion about, information is not enough. You can't base decisions on information. You have to apply judgment or bias. So whether information is complete or incomplete, you always have this distortion. So that's the first. Always there is a bias in the markets. Some mispricing. It's not an accurate reflection of an underlying reality. But the second proposal is that the mispricing of in the financial markets has ways of affecting the so-called fundamentals that prices are supposed to reflect. So instead of a one-way relationship where the prices are a passive reflection of supply and demand, conditions of supply and demand, effectively there is a two-way connection, a circular connection, a two-way feedback mechanism where the prices, the mispricing, can affect the conditions of supply and demand. So that I call this principle reflexivity, and I propose that that is the new paradigm that ought to guide us in understanding markets. So markets, instead of being passive reflections, they are active agents in shaping the future. So when you talk about how markets are prescient, that they anticipate what happens in the future, actually they are not so prescient. They actually shape the future. So that's why market prices very often reflect what is going to happen in the months to come. But they don't always reflect it accurately. Very often they do, and that's why because you have this two-way connection, that's why you have this impression that markets are prescient. They are that way because they actually actively bring about what happens in the future. So that's the sort of the general theory, which then allows me to propose a theory of bubbles, because if markets don't tend towards equilibrium, you have this two-way feedback. Then you can have a initially self-reinforcing but eventually self-defeating process, which is very far from random, because it can go very far in one direction, much further than if you don't have this reflexive connection working. So in every bubble, you have basically two components. One is a trend which actually prevails in reality. There is always a foundation, and it doesn't come out of thin air. And the second thing, that there is some kind of misconception relating, misinterpretation of that trend, which very often is corrected by markets, most often is corrected. The misconception is eliminated by markets correcting it. But occasionally, this reflexive connection can actually reinforce both the trend and the misconception. The most simplest and most common bubbles occur in real estate. The trend, underlying trend, is an easy availability of money, willingness to lend. And the misconception is that the prices of real estate are independent of that willingness to lend, so that they can serve as collateral on which you can lend. But effectively, since the prices are influenced by the willingness to lend, the ease of credit can generate a self-reinforcing process where you have housing prices or real estate prices rising, and because the loss experience is very favorable, there's also a relaxation of the conditions under which you're willing to lend, and that goes on where eventually people buy or hold houses or real estate, not because they need them or because they want them, but because they expect to appreciate in value. And so they hold more than they need. And that goes on, self-reinforcing, until it becomes unsustainable. And then you have a reversal, and prices fall, willingness to lend stops, collateral loses its value, and you have forced liquidation, and that reinforces the decline. So boom-bust sequences tend to have an asymmetric shape. They develop slowly, rise slowly, and when you have forced liquidation, you have the crash. So that's the most common form, but it happens in real estate. It happens also, of course, in stock market. Like, for instance, you had the IT bubble and so on. Now, so that's the theory of bubbles, the role of the importance of misconceptions. Then I would propose a specific hypothesis with the situation that we are in currently. And I contend that it's not a simple bubble. It's what I call a super bubble that's composed of other bubbles which have developed over a period. So you have, on the one hand, you had the housing bubble, which acted as a simple bubble that acted as a detonator of the super bubble, which has been growing for the last 25 years. And that super bubble is a much more complex, much more difficult structure to understand. It has, as its base, as the trend in reality, is in fact the increased use of leverage and credit, which has actually been prevailing ever since the end of the Second World War. If you look at the figures, you see that credit as a percentage of the GNP has been growing over for the last ever since 1945. The misconception is what I call market fundamentalism. The belief, in fact, this prevailing paradigm that the markets tend towards equilibrium, deviations are random, and markets are self-correcting, and therefore they should be deregulated. Regulation is unnecessary or should be reduced. The state should play a minimal role in the economy. And of course, globalization. So you've got deregulation, globalization. Globalization was a market fundamentalist project that really took off in the 1980s with Ronald Reagan as President of the United States, Margaret Thatcher, Prime Minister in the UK, both believers in the magic of the marketplace. And if you have global markets, it means that financial capital is extremely difficult to regulate or to tax, because it can go somewhere else where it is better treated. So it's very favorable to financial capital. So globalization then became the dominant creed and spread throughout the world. And the third factor was, of course, financial innovation, financial engineering. And that was based on this false paradigm that deviations are random. And so the risk calculations, because were based on that. You had value at risk, VAR, which was the sort of dominant calculation that was used, and generally it became very sophisticated. And the idea was that risk can be quantified, and it can be calculated, and you can actually reduce it through financial engineering. So you invented various instruments like CDOs, where you felt that by dividing geographically or diversifying geographically, you reduce the risk. And then you could slice it and dice it, and you could, again, provide people the kind of risk they want. Now, these instruments were, as I say, built on a false premises, which only took into account the risk that could in fact be quantified and manipulated. It left out of account the uncertainty, which actually cannot be quantified and has to do with this the basic imperfection of human understanding, our inability to predict the future, and the influence that our imperfect understanding has on the course of events. So actually, that general theory has an implication far beyond the financial markets, because I would contend that human events have a fundamentally different structure from natural events, because this imperfect understanding doesn't enter into natural phenomena. There you only observe the phenomena, and you have an independent criterion, the phenomenon. If your statement corresponds to the facts, then that statement is true. That's the correspondence theory of truth. And in natural science, that has produced tremendous insights and a real deep understanding how nature functions. But in human affairs, our own understanding, imperfect understanding, enters into the causal chain, and it introduces an element of uncertainty that is missing in the natural phenomena. So even natural phenomena, you have this uncertainty principle, Heisenberg's uncertainty principle. But that principle applies, I call it the social uncertainty principle, applies to human affairs much more strongly, with much greater force. Because when Heisenberg discovered the uncertainty principle, it didn't alter the behavior of the quantum particles or waves that he was dealing with. Whereas in human affairs, when you introduce a theory that is generally believed, be it Marxist theory of history or equilibrium theory in economics, it changes the behavior of the subject to which the theory reflects. So, as a result, as an illustration, the medieval alchemists barked up the wrong tree when they tried to change the base metals into gold through incantation. It didn't work. But in stock market, financial markets, it does work. So I've been practicing it, and it works. So this is a pretty fundamental thing, that it means that human constructs have a different structure from natural constructs. So when you look at, let's say, an automobile, it wouldn't exist if it didn't actually carry you from one place to the other. But in human affairs, you can have constructs like states, markets, institutions.
London G-20 summits.
For instance, that exist. They last, but they don't actually fulfill the purpose for which they are designed. So there's this fundamental imperfection in human affairs. Now that's very important because it applies to markets, but it also applies to regulators. And one of the mistakes that we make, a very common mistake, that just because one set of arrangements is flawed and is proven to be flawed, you then take the opposite of it and say that's perfect. And that's actually how market fundamentalism came to the fore because of the failure of socialism. We now have to be very careful because that has proven false. And obviously, markets are imperfect. They do need regulation. But we have to remember that regulations are also flawed. And in fact, they are more flawed than markets because regulators are not only human, but they are also bureaucratic. And they are also subject to political influences. So actually, markets on the whole functions better than governments. Nevertheless, this idea that we could let markets function without government intervention failed, and we do now have to have government intervention and regulation. So that's, I think, the conceptual framework in which we have to look at the situation. Now, the problem that we have now is actually not one problem, and it's very important to distinguish between the two. One is we have a collapse, and it's a pretty profound collapse. I mean, something as powerful as the financial system has actually collapsed. Credit has collapsed. And it has affected various elements of our lives. I mean, the real economy has been in free fall since September. And we must stop the collapse. We have to arrest it and reverse it. So that's one problem. And second, we have to recognize that the system that has collapsed was obviously flawed. And therefore, it cannot be reconstituted the way it was. It has to be rethought and a new system, a modified system, developed. And it's very important to distinguish between the two, because it turns out that what we need to do to stop the collapse, what we need to do in the short term, is almost exactly the opposite of what we need to do to rebuild a sound, near equilibrium, stable system. So that makes the whole task extremely difficult. And I think one has to have some idea of what that stable system ought to look like in navigating this course where you face a collapse of credit. So what do? You have to actually increase the money supply to try to make up for the shrinkage of credit. You have to recapitalize the banks in order to restart the credit flow. And of course, you also have to deal with the housing situation, which is the proximate cause of the collapse. And you have to prevent housing prices from overshooting on the downside the way you overshot on the upside. So you have to bring some relief on mortgages. You have to reorganize the mortgage market. So what you need to do in all those things, as I say, is the opposite of what you need in the long term. But it's important to think of what the long term ought to look like when you are reorganizing or when you are dealing with the short term. To give you an example, in the mortgage market, I believe the system has actually pretty completely broken down. Therefore, it would be worthwhile to introduce a better system that wouldn't break down so easily. So I've been proposing the Danish model. I call it's a Danish model because that's where it was introduced. It's a system of mortgages where the mortgages are actually converted into securities. So the connection between the mortgage and the security is never broken. Each mortgage automatically becomes a security, and the securities are uniform. They can be issued by any number of mortgage originators that are regulated and meet the conditions that regulators set. Not like here where we had only, we had Fannie Mae and Freddie Mac, sort of government monopolies. So it's an open system, the householder can repurchase or redeem his mortgage by buying a security of equal amount. So, for instance, if interest rates go up, the securities fall in value, so he can refinance, and therefore, by buying the security at a discount, and so the value of the houses generally doesn't exceed the value of the mortgages. I could go on, but I'm told not to. And I have some ideas about what we need to do, and I have some ideas on the G20. I've been pushing the idea of special drawing rights, which would bring great relief to the developing world, but I'd rather explain those things in answer to questions rather than to keep on talking.
Well, George, thank you so much for walking through the system of the theory of reflexivity, and thank you very much. Before we move to the audience, let me ask you to share your thoughts as you did yesterday in the Senate Foreign Relations Committee, and you have recently, both in the Wall Street Journal and the Financial Times, shared your thoughts on your concern about these periphery countries, developing countries, how important they are to get them right, and your conception of SDRs. And frankly, I would like to hear just a bit more on this tension between what we need to do in the near term, and which I think Bernard Schwartz and a lot of other people have said, keeping people in their homes, developing the real economy, getting jobs going. But then what mistakes don't you want to see in terms of the longer term horizon we have?
Well, the G20. It's important to realize that the periphery countries, the developing world, is facing an even more serious crisis than we do, because in the aftermath of the Lehman default, basically the European countries, the United States, and Japan, and any other country that could, guaranteed the banking system against default. Basically said that no financial institution of systemic importance will be allowed to go bust. And the countries at the periphery cannot give guarantees that would be equally convincing. So the result was that capital took flight from the periphery back to the center, and that's when Eastern Europe went into crisis when Brazil, which had been doing very well, suddenly had a financial crisis and the currency dropped 40% and so on. So looking forward, the periphery countries are not in a position to print money the way we can. And therefore, we must help them to be able to protect their banking systems and to engage in counter-cyclical policies because it's a global problem where you need to reinforce global demand. Therefore, it's in our enlightened self-interest to help them to effectively print money. And special drawing rights, which are very complicated, arcane instruments, effectively is an international creation of money. And it can be used. The periphery countries need them, and we don't because we can print our own. And therefore, the rich countries should lend their allocations to the poorer countries, and it doesn't cost them anything. So this is a rather costless, effective way. It has indirect costs, of course, because they will use that money and buy our goods. But I think we want them to buy our goods because that will help our exports. So SDRs are, as I say, it's a complicated instruments, difficult to understand. I can't contend that I understand it fully, but it works. It exists. It has been issued already. It should now be issued on a larger scale. So that's I think that would make a big difference.
Let me open the floor, but as I do, I would like to ask George one thing. You are well known to have applauded the Obama administration coming in. How do you think the Obama administration, do you think they get this? Are they prepared to sort of own this? Are they moving in the direction you think is constructive in terms of both achieving not necessarily an equilibrium at home? We've had a lot of talk, as we did last night with Bernard Schwartz and others, who are very worried about the deterioration of the real economy and these sort of larger macroeconomic issues as well. Are you pleased with where the Obama administration is going? Do you think that they need to read your book more carefully?
Well, I think actually I give them very high marks in every area except one, and that's the recapitalization of the banks. It was, of course, it's a good excuse that TARP was proposed by the previous administration and applied the wrong way. But unfortunately, they should have said that was the wrong way. We are going to do it right. We need additional funds to do it. And I think at that moment, the moment of enthusiasm, fresh out of the gate, he would have gotten that money. And then we could have recapitalized the banks the right way, which would be to draw a line over the past accumulated bad assets and create new banks on top of these old banks. Instead of good bank, bad bank, have new bank, old bank, and keep the old capital to cover the old assets, which are still deteriorating and will continue to deteriorate for several years because the commercial loans, commercial real estate has not yet fallen in value.
But is on its way, is that?
It's inevitable, it's written, everybody knows it. There are already some transactions which reflect, anticipate it, so we know they'll drop at least 30%. And since they're basically borrowed up to 85%, you can see that there's a significant hole there, right? If it's going to drop to at least 70 and you've lent 85, then you're going to be at least 15 out of money, but it's more than that. And that has not yet been recognized because the loans only come due every 5 years. So we will get it in the next 4 years. It's already there, but it's so the existing capital should be kept to cover the existing assets, and the new capital should be injected and should not be affected and should not be liable for the depreciation of those assets. Then you would have these new banks, new with lots of deposits, because the deposits are very valuable, and newly raised fresh capital without the commitments, and then those new cos would be out there eager to take advantage of these extremely high margins which currently prevail. So that would be the way to really solve the problem. It could have been done. It will now take a long time, and hopefully we will eventually move there. I haven't given up hope, but we are definitely not there.
Well, we were told that some of them are watching you on TV right now. So, Robert, very quickly, brief.
Robert Schroeder with International Investor. Mr. Soros, first, you were quite right when a year ago you predicted as many as a third of the hedge funds might go under. I think we're now approaching 1,500 that have been declared insolvent or have been merged in one way or another since then. So you were right on that one. But my question has to do with you. 20 years ago, you were the headlines read, "Soros Fund breaks the Bank of England." How fearful are you that there's a young George Soros out there at one of these hedge funds that's going to put undue pressure on the Federal Reserve, the central bank of the United States?
It could happen, and in the automobile industry, it's already happening, because it's hedge funds that own the auto companies. Yes, it's. But let's face it, the leverage in hedge funds is generally speaking, much lower than it is in the banks and in investment banks.
Right here.
Hi, Dennis DeBuscher from ISI. T-bills today traded negative on a one-month basis, first time since December. And my question is, despite the huge amount of issuance of Treasury securities to soften the blow from the unwinding of the super bubble, so my question is, are we on the verge, for lack of a better term, a super-duper bubble in U.S. Treasuries?
In a way, yes. Because in order to make up for the collapse of credit, we are effectively creating money. And that's what the quantitative easing, that's what quantitative easing means. And if and when credit is restarted, you would then have an incredibly swollen monetary base, which, if it were leveraged, you would have an explosion of inflation. So right now, we are in a period of deflation, but it could easily tip over where you are facing inflation. So you then are faced with the task of draining the money supply as fast as credit is created. So it's a two-step operation to regain balance, equilibrium. I don't want to use that word. So there is that danger, and it could easily get out of hand.
Jeff Stacy at the Department of State. We got to go quickly.
Mr. Soros, the Europeans for the G-20, they want to regulate. The U.S. wants them to stimulate. Incidentally, it's interesting that the current EU president, who maligned the Obama plan as a way to hell, is about to lose his job as the Czech prime minister. But aside from that, what is going to happen if it goes bust? And are the answers, instead of a Bretton Woods 3, is it a Bretton Woods 2? Is it a Basel 3? And can the governors of the fund sort of do this on their own, along the lines of an earlier suggestion that just the top four do it?
Well, I think you have a number of questions there.
Pick the one you like most.
I think that you do need a Basel III. Basel II has failed. It put the onus of regulating risk on the risk takers, and there is a systemic risk, which is not just risk to the participants, but to the system, the stability of the system. That has to be recognized. And that means that it's not enough to regulate money. You also have to regulate credit. With a given amount of money supply, you can have an asset bubble, and you can have a burst of it. So you need to go against the prevailing bias of the market. When a self-reinforcing bubble is developing, you then have to tighten margin requirements and minimum capital requirements. In other words, you have to have variable capital requirements, and Basel III should be based on that principle.
Fred, last question.
Yeah, Fred Singer, I want to follow up on Steve's question. You've properly focused on what must be the number one priority, financial system and fixing it. Why does the White House insist on stating that they have three priorities: healthcare, education, and energy? It's confusing the public, it's confusing the Congress, and it's splitting his support. There's no problem with healthcare that can't wait for a few months or a year. Education isn't in a crisis. The Education Department was established by
We're
Reagan.
going to let your question hang
I
there.
got your
'Cause I know
question.
you've
And
got-
energy,
and
there's
that-
no
I
crisis in
disagree with
energy,
you.
there's no problem.
Yeah,
Thanks,
I
Fred.
disagree with you fundamentally, because you have to think of the world as you want it to be when you get out of the crisis. And there, education, healthcare, and climate change will play a very important role. So in getting there, you have to have those. So when you are pumping money in, you have to pump it into education, you have to pump it into fighting global warming. This is the time to address those issues, and I'm very, very glad that President Obama is doing it.
George, before I invite Steve Cole to come up and offer some closing comments, and I want to thank everyone for being here. I've been just told we've had 5,500 people. It's been at least some time watching online this show. And are you disturbed by how opaque the decisions have been on the bailouts? Have you been? I mean, you're such in Open Society Institute, as you looked at oil industry firm or oil industry dependent nations or others. You've been such a promulgator and crusader for transparency. This hasn't felt to me like a crisis that we've dealt with transparently, and I'm interested to see where you are, because have you felt like America is succeeding in an open society format in dealing with this with the public?
I see it differently. It's not a question of transparency. It's a question that you have a dynamic collapse, self-reinforcing, and our understanding of what's happening is always lagging behind events. It's a collapse of the system. It's more than what one can comprehend, because we are, we have certain things that we are used to, and those rules don't apply. And for us to learn what the new rules need to be takes time, and time is short, and things are happening very fast. And financial institutions have been collapsing very, very rapidly. So it's the lack of time and the lack of understanding, and Obama, where I find that why he's been lagging in this field, is because he is the great uniter. He wants to forge a consensus. And this is a situation that it automatically leaves you behind the curve. Events will always outpace the understanding of those events. To deal with them, you actually have to be ahead of the curve And instead of following consensus, you actually have to create it. And this is where he had this opportunity when he came in. But unfortunately, the plans weren't ready. And so it's really the shortage of time, this condensation of time, that creates the crisis situation.
Please join me in thanking George Soros. Let me invite Steve Call, the president of the New America Foundation, to say a few words with us before we adjourn. If you can stay in your seats for a moment, I would appreciate it. So, Steve Call.
Thank you. I won't take much of your time, but in closing the conference, I'd like to emphasize for all of you who are still watching online and with us that today marks the beginning of a body of work that I hope you'll all stay involved in. We intend to reconvene in this in similar formats several times over the next few months. In addition, many of the people who you've seen on stage and heard today are launching a series of publishing initiatives online, a new economic journal called Value Added. All of this can be located at newamerica.net. And I'd encourage you in that way that publishing now operates to join in our efforts to carry this discourse forward and to deepen it. You know, we started out this morning by observing that we were in a period of transformation and that there was a tension in this extraordinary crisis between that which is politically possible and that which analytical rigor and deep thinking requires. And I thought myself, listening over the 4 hours, that the totality of comment, though very diverse and from diverse perspectives, clarified what that really means now. And one of the things that it clarifies is the extent to which all of the speakers, climaxing with Mr. Soros, emphasized that the structure of this crisis lies in global imbalances and to some extent in global systems, global governance. But this is occurring at a time of intensifying provincialism and sort of constraint in national politics, not just in the United States, but elsewhere. And that one of the functions of work of this kind, that this body of work, has to be to break down that set of constraints and to bring American discourse as well as other discourse into line with where the crisis is really structured, and that is in the global system. With that comment, let me just thank, first of all of you who are still in your seats 4 hours later, for your patience and for your politeness and for the excellent quality of your questions. Second, to all of our speakers and partners, those in the front row, those who are standing in our overflow rooms or in the back, many of whom traveled great distances to be with us, or, as is obvious in many of their cases, took time out of extremely pressured schedules to share their thoughts with us. Very high level of quality across the day. And then thanks as well to our moderators, the inimitable Steve Clemens, Cheryl as well. And finally, if you would join me, this event stress tested a building that has been occupied by us for a grand total of 3 weeks. Everything from the air conditioning to the video systems to the microphone systems. And I think the only potential collapse is of the coat rack. So if you go out and find your coat not in the order in which you left it, that is the explanation. But otherwise, please join me in thanking our incredibly hardworking staff for making this a successful day. Godspeed, and we're adjourned.
I also want to just say one word because my boss did get to, but we couldn't be here, and we're not going to be here the next second or third without much thanks to Bernard Schwartz. This is the Bernard L. Schwartz Symposium. We're very, very grateful. He is such a great partner to work with because he's a guy who loves, like George does, feisty debate, wants people he can wrestle with, wants to talk about the national priorities of the country. And what I've, just in closing, have been so intrigued with both our speakers here and the supporters is the fact that you were willing to support folks that want to carve the apple differently and want to talk about it and wrestle over it. And we were very grateful for that opportunity. So thank you all for being with us. Thank you guys online. Great. Sorry I hit it.